In today's video, I am going to be breaking down what I think are the best ETFs for your TFSA. So of course, the TFSA is a tax-free savings account here in Canada, and you can do stock and ETF trading with it. Now, the thing with TFSAs, if you don't already know, is whatever money you lose in the account, that contribution room is now gone forever. So you really want to go as safe as possible in your TFSA. Especially if you're young, this could be huge growth over the next 20, 30, even 40 years, and it's all tax-free. So let's get down and let's check out some of these amazing ETFs. So XIU is the first one we are going to be talking about. It's the iShares S&P TSX 60 Index Fund. Basically, it holds the top 60 companies on the S&P TSX, which is the Canadian stock market. Generally speaking, you want to look at index funds for your TFSA. Now, of course, I personally do hold individual stocks. I like TD. I also have companies like CIBC, which is CM on the ticker, in my own TFSA, but I also do hold a lot of ETFs too. So some of the key facts about this specific ETF is, of course, it does hold those 60 stocks. It rebalances pretty frequently every quarter. So while some ETFs do rebalance every week, or even once a year, this one does it quarterly, which is a good thing to know because then you know that, of course, let's say a month and a half from now, this ETF could be a little bit unbalanced when it comes to what's inside of it. The largest holding could grow from 6 to 9%. And then when that quarter is over, it's going to then rebalance back down, potentially. However, this is something to really keep an eye on when you start looking at the overall index versus an ETF like this. The average distribution yield is something that I really do like as well, and that is 2.58%. It also pays its dividend every single quarter. And every quarter, right now, anyways, it's paying, or at least its last distribution is paying 20 cents per share. The next thing we really want to look at is the fees and how much it's going to cost to hold. And the reason why we want to look at this is because things like mutual funds will be extremely high, while some ETFs will be extremely low. This is 0.18%, which basically means that if you're investing $100 into this ETF, you're going to give them, the company iShares or BlackRock, 18 cents a year for every $100 you put in. Now, the reason why you're paying them is because obviously they are managing your money. However, when we really think about it, what's better, an ETF or a mutual fund inside of a TFSA? My opinion, it's an ETF. A mutual fund does, in most cases, the exact same thing as an ETF. However, with a mutual fund, yes, they manage it a little bit more frequently, but you're usually paying 2.5%, or even 3% every single year, which for every $100, you're giving that bank or that company an extra $2 or $3 instead of, for example, this one where you're just given 18 cents. It's going to really grow your money a lot bigger over time. And currently, as of July 2nd, the holdings in this ETF, the largest is Shopify, which is no big surprise. They are now one of the largest companies in Canada. They were surpassed by Royal Bank for a while, but I think Shopify is back to being number one again. These are basically going to mirror the actual TSX in most cases. Of course, if they need to rebalance, they need to rebalance, but generally speaking, these are the largest companies in the world. Now, they do hold 60 companies. However, the top 10 holdings will be usually the heaviest weighted out of the 60, and those are the ones that will really move this ETF the most. And just like anything in Canada, the banks are massive. In my own personal opinion, they are basically cheating the system in a way because, of course, they are heavily regulated in Canada. And, of course, you're not going to see what happened in the States in most cases. So, Royal Bank, TD, some of the biggest companies. TD has a large U.S. holding of banks. And then, of course, Bank of Nova Scotia, which is huge in the Bahamas and in Europe. So you're not just getting exposure just to Canada, but you're also getting exposure to around the world. BMO is basically building their U.S. operations as well, and CIBC is really good too. I really like how CIBC usually raises the dividend. However, there is something that you have to keep in mind when it comes to companies like the banks, and right now they can't raise their dividends. The Canadian government is not allowing them, or at least the watchdog is not allowing them to raise their dividends right now or do any share buybacks. So once that does get lifted, I would assume that the Canadian banks will just skyrocket again, because then the banks will be able to do share buybacks and raise the dividend. When that happens, the share price will go up as well. And as I was mentioning, financials is huge when it comes to Canada. Energy is number 2, and information technology is a growing sector in Canada. I would assume that this will grow over the next 10 to 15 years and may even surpass the financials, but that's hard and difficult to say because the financials and energy sector are massive in Canada. And the 5-year chart looks exactly like this on this ETF. Recently, ever since the bringback of the virus has been over, or at least edging out of our economy issues anyways, it's been having massive growth, the market has, and we're going to continue to see that most likely. Maybe not as this kind of an acceleration. I would assume that there's going to be a little bit of a sideways trading for a while. However, at the same time, you can't deny the growth over 5 years is quite massive. Next is ZQQ, which is a BMO ETF. This one does cover the NASDAQ 100, which is the top 100 companies on the NASDAQ. It is hedged to the Canadian dollar, which just basically means that there shouldn't be that much currency fluctuations. And what I'm saying, or what I'm meaning by that, is if the NASDAQ goes up by 10%, yet our currency to the American dollar goes down 10%, then in generalities, your money's not going to be growing. However, if it's hedged, which means that they hold a little bit more cash on hand to be able to deal with those fluctuations in the currency price, then you should be pretty well close to mirroring the NASDAQ market. So the volume on this ETF is huge, just like the last one. You're looking at 76,000 shares traded every single day on average. This one, however, does distribute a dividend once a year. Usually it's going to be in December. And the benefits to this fund is it's going to have larger growth historically. That's usually what the NASDAQ does. It's heavily in tech. So this is definitely a great ETF if you want to have the ability to mirror the market, but also have huge growth. The only thing is the dividend is not very big. As we can see, the cash distribution is very small. However, the total distribution per unit is actually quite large in my opinion, but it's mostly reinvested anyways. And of course, it is going to be the largest companies on the NASDAQ, and that's going to include companies like Apple, Microsoft, Amazon, Facebook, Alphabet again, which is going to be Google. For those who don't know, Tesla is one of my favorites. Nvidia is another one of my favorites. PayPal and Adobe. I love PayPal, not necessarily as a stock. It's a great company. It's a great stock. Don't get me wrong, but I just love it because I use it for my everyday operations for my company. And this is what it basically looks like. Over time, you're looking at something that was in the $35 range 5 years ago, now trading at $106. If you're looking for exponential growth and you're younger or even older, this is a great way to do it. ZSP is another one that's great. This is the S&P 500 index ETF, so this is going to be following the S&P 500 in the States. This one's annual distribution is 1.24%. Its management fee is very small at 0.09, so even lower than the first ETF that I showed you. And then, of course, the distribution is going to be quarterly as well, and 158,000 shares on average every single day being traded is absolutely fantastic. That's the distributions, around 18 cents per share. And that's the holdings. Once again, very tech heavy. The Americans are extremely tech heavy. We have to remember that. However, they do have some financials in there as well. I would classify Berkshire Hathaway as an ETF, not really necessarily as a stock, but at the same point in time, it's just basically a holding company. They hold a lot of different stocks. Again, huge growth. It was trading at just over $30 a share, now trading at close to $60. It's doubled in 5 years. If you're looking for a larger growth, it's a little bit better. NASDAQ is going to be a little bit better for you. So the last ETF I just showed you. And then my favorite right now, and it's all because of a few of my followers have been telling me about this for a long time, and I started to invest into it not very long ago. So I have to say thank you to Mahroz Ahmed. But anyways, CI Tech Giants Covered Call ETF is fantastic. This is a ridiculously, amazingly good ETF. Its management fee is a bit higher. It's 0.65%, so it's the highest out of all the ones that I've talked about today. However, what we are looking at here is a fantastic growth and a ridiculously good dividend. So the 12-month trailing distribution is 10.6%. That is huge. We're looking at something that's close to 11% dividend. That is ridiculous. Think about it this way. If you had 70,000, which is close to the max, I think it's about 76,000 right now for a max on a TFSA. If you had getting paid 10.5% a year, you're looking at a massive dividend of, let's call it 10.5% dividend. Let's just make math easy. You're looking at a massive, every single year, $7,350 of dividends on average every single year, which would be divided by 4 for the quarter. So every 3 months you're getting paid $1,837, which then if you divide that for every month, you're looking at a massive tax-free $612 a month on this ETF if you maxed out, or pretty close to max out, your TFSA. If you actually truthfully maxed out as of 2021, you are looking at 10.5%, $7,900 tax-free every single year, $7,980. If you divide that by 12, you're looking at a massive $665 tax-free every single month. Now, remember, this only pays every 3 months, but that's what it averages down to every single month. That's huge. For most people, that's a massive, paycheck, like a 2 week, even a 1 week or a 2 week paycheck for some people. For most people who are working part-time or minimum wage, that is huge. That's basically equal, if you were to get taxed on this income, that would be equal to about $765 of income every single month. That's huge. Its top 10 investments is Applied Materials, Micron Technologies, Intel, Alphabet, Booking Holdings, Broadcom, Intuit, Microsoft, Nvidia, and Texas Instruments. Those two I really, really like. And even though they have a ridiculously high dividend, look at the growth it's had, $12.50 to $22 while getting a ridiculously high dividend is absolutely amazing. I hope that this video helps you and your investment journey. If it does, hit that like button and subscribe, and I'll see you guys again next time.